All right, let's be honest, talking about the economy can be about as exciting as watching paint dry. But here's the thing, it affects all of us, whether we like it or not. Remember those empty shelves at the supermarket last year? That, my friends, was the economy throwing a tantrum. Central banks are like the referees of this crazy economic game. They try to keep things fair and prevent the whole system from going belly up. And lately, they've had their work cut out for them. Pandemics, supply chain chaos, you name it, it's been a wild ride. But how do these central banks actually anything? Well, buckle up because we're about to dive into the world of monetary policy. Don't worry, it's not as complicated as it sounds. Think of it as trying to keep a bunch of hyperactive puppies under control. Except instead of puppies, it's banks. And instead of treats, it's money. Monetary policy. Sounds fancy, right? It's basically just a toolkit central banks use to manage the economy. Think of it like a mechanic adjusting your car's engine. They use different tools to make sure everything runs smoothly. In the old days, central banks mostly focused on controlling how much actual cash was floating around. But times have changed. These days, it's all about something much more powerful: interest rates. Interest rates are like the steering wheel of the economy. If the economy is moving too fast and things are getting out of control, central banks can raise interest rates to cool things down. Higher interest rates mean borrowing money becomes more expensive. This encourages people to save more and spend less, which can help to slow down inflation. On the flip side, if the economy is stuck in a rut, central banks can lower interest rates to give it a boost. Lower rates make borrowing cheaper, encouraging businesses to invest and consumers to spend. But how do central banks actually control these magical interest rates? Well, it all comes down to something called bank reserves. Section 4. Bank reserves, the cash cushion. Imagine banks have to keep a certain amount of money on hand at all times, like a rainy day fund. This is called a reserve requirement. Central banks can adjust this requirement to influence how much money banks have available to lend out. If they want to stimulate the economy, they can lower the reserve requirement, freeing up more money for loans. Think of it like this: if banks have more cash to lend, they're more likely to offer lower interest rates to attract borrowers. And who doesn't love a good sale on a loan? But here's the catch. Central banks don't actually change the reserve requirement very often. Instead, they use other tools to influence interest rates. Let's dive into those, shall we? Section 5. Setting the rates. How central banks move the needle. Instead of constantly changing reserve requirements, central banks typically target specific interest rates. Two of the most important ones are the federal funds rate and the discount rate. The federal funds rate is the interest rate banks charge each other for overnight loans. Don't worry, it's not as boring as it sounds. By tweaking this rate, central banks can influence all sorts of other interest rates, like those on mortgages and credit cards. Then there's the discount rate, which is the interest rate central banks charge commercial banks for short-term loans. Think of it as the emergency rate. If a bank is running low on cash, it can always turn to the central bank for help, but it'll cost them. By adjusting these key interest rates, central banks can steer the economy in the right direction. But what exactly is the right direction? Well, one of their main goals is to keep inflation in check. Section 6. Inflation, the price we pay. Inflation is basically when prices for goods and services go up over time. A little bit of inflation is normal, like a gentle breeze. But if it gets out of control, it can be like a hurricane ripping through your wallet. Remember those crazy gas prices last year? Yeah, that was partly due to inflation, and central banks were working overtime to try and get it under control. They do this by raising interest rates, which can help to cool down the economy and slow down price increases. Of course, it's not always that simple. The economy is a complex beast, and sometimes things don't go according to plan. And that, my friends, brings us to the end of our whirlwind tour of central banking and the magical world of interest rates.